Hello everyone and welcome back to another Stock Unlock video. In today's video, we are going to be talking about 3 dividend stocks that I think are looking very cheap in the market right now. And these 3 dividend stocks are in the financial sector, and all 3 of them are actually banks. Now, I think that the overall sentiment, if we want to call it that, around the stock market and the US economy right now, and really the global economy actually, is that we are going to be entering a recession, and a fairly big one. Now, what I think that this is leading to is a lot of people being bearish towards financial stocks and the overall financial sector, and especially banks. But I think that this fear and this uncertainty and this negative sentiment towards this sector is also causing some opportunity for long-term investors. But as always, this is just my own opinion and this is not financial advice. So please, don't take what I say as financial advice. But with that being said, let's now hop into Stock Unlock, and let's take a look at the 3 stocks that I think are looking very attractive right now. All right, so the first stock here is JP Morgan, and I'm sure that everyone knows what JP Morgan is, but this is actually the largest bank in America. And right here, we can see that this stock topped out at about $172 a share in about, October of 2021. And we can now see that the shares are in about a 24 to 25% correction. So JP Morgan is in this massive correction right now, over 20, and I do think that this is making the stock look rather attractive. If we head over to Stock Unlock's freeform tool, we can see that JP Morgan's price to earnings ratio is sitting at about 7.9 right now. And down here, we can see that over the past decade, JP Morgan's average price to earnings ratio has been about 10.8. So JP Morgan right now is selling for quite the discount to its 10-year average price to earnings ratio. Now, if we also take a look at JP Morgan's price to book instead of the price to earnings, we can see here that JP Morgan is trading for a price to book of about 1.17, and this is actually just below JP Morgan's 10-year average price to book of 1.18. So in terms of price to earnings, or in terms of earnings, JP Morgan is selling at a discount to its historical averages, and a pretty significant discount as well. But in terms of price to book, it is selling at about average right now. But now let's move on from price ratios, and I want to show you guys JP Morgan's dividend per share growth. And right here, we can see that over the past decade, JP Morgan has grown its dividend per share at a compounded annual growth rate of 14.3%. That is a fantastic growth rate to JP Morgan's dividend. And the company today still pays a pretty significant dividend of about 3.4% on today's shares. So the company pays about a 3.4% dividend, and it has been growing this dividend at about 14% annually. And I do believe that JP Morgan will continue to grow the dividend in the future. And in like 20 years, I do believe that JP Morgan will be paying a significantly higher dividend than it is today. Now, also, JP Morgan does not just pay a dividend. And if we take a look at the shares outstanding over time, we can see that JP Morgan has been buying back shares consistently over the past decade. And over the past 10 years, JP Morgan has bought back an average of about 2.6% of the shares every single year. So on top of the dividend, JP Morgan is also returning cash back to its shareholders through share buybacks. And if we actually take a look at JP Morgan's percent return to shareholders, over the past year, JP Morgan has returned about 8.3% to shareholders through dividends and through share repurchasing. So JP Morgan is returning a massive amount of cash back to their shareholders, and I do believe that they will continue to do this in the future. So the last thing that I want to do for JP Morgan is head over to Stock Unlock's DCF calculator, which is also known as a discounted cash flow calculator. And we are going to be tracking JP Morgan's earnings, and these other stocks that we are going to be taking a look at, we're also going to be tracking earnings. Now, we're also going to be projecting out JP Morgan's earnings over the next decade, and we can see right here that over the past 10 years, JP Morgan has grown earnings at an annual rate of 9%. The stock has also traded at an average price to earnings ratio of about 10.79 over the past decade, and the company has repurchased about 2.54% of its shares annually over the past 10 years. Now, I'm also saying in our DCF here that I want a 10% discount rate, or essentially a 10% return rate on my JP Morgan investment. So this DCF right here is just using JP Morgan's historical 10-year figures and projecting that out into the future. And when Stock Unlock's DCF does that, it tells us that the discounted fair value for JP Morgan is actually about $183 a share, or about 59% above where the stock is currently trading. So basically what that means is if JP Morgan can actually replicate its historical performance into the future, then the stock is looking rather cheap right now. But if we do enter a recession that I'm honestly not too optimistic that JP Morgan will grow at its historical rates. So let's say that JP Morgan will grow its earnings at 5% a year instead of 9%. And let's also drop this price ratio down to a perfect 10 PE. And even when we do this and we say that JP Morgan is going to grow less quickly and trade at a slight discount, it still tells us that the fair value for the shares is about $117 or about 1.4% above where the shares are currently trading. So I do think that JP Morgan is looking attractive even when we enter it into Stock Unlock's DCF calculator, and we are a little bit conservative with our numbers and say that JP Morgan is not going to grow at the same rate as it did over the past 10 years. Yeah, in my opinion, I think that JP Morgan is looking rather attractive right now if the company can continue growing earnings at 5% over the next decade. So now let's move on to the second stock that I want to talk about. And this one is actually Bank of America. And just like JP Morgan, Bank of America is in quite a significant dip right now. And here we can see that in February of 2022, so just like 4 months ago, Bank of America was trading at about $49 a share. And now the stock is trading down about 26%, and it's trading for about $36 a share. Actually, today it's trading for $32 a share, so the stock is probably in about a 30% correction right now, which is a pretty massive correction for this company. So what I want to do is actually head over to Stock Unlock Insights for Bank of America, and I want to take a look at the bank-specific metrics right here that we score on Stock Unlock. So basically, we just scan the bank's fundamentals and its financials, and we grade all of the key things that investors look for. So for example, right here, we can see that Bank of America's total deposits have increased by 9.95% over the past year, which is very good for a bank. The interest income also increased by 7%, non-interest income increased by 2%, loans increased by nearly 11%, tangible book value increased by 1%, return on tangible equity was 18%, and the bank's efficiency ratio was about 0.67. So overall, Bank of America's bank-specific metrics are looking either average or very good. And the bank-specific metrics have a score of 4.0 out of 5. So honestly, when we take a look at the past year, Bank of America's fundamentals look like they are growing quite well, especially for a bank. So I do think that this 30% correction that Bank of America's stock is seeing could be presenting an opportunity. So now let's head over to our freeform tool. Let's take a look at Bank of America here. And let's take a look at the price to earnings ratio and compare the current price to earnings ratio versus its historical averages. And let's zoom into about 2016 on this one. And right now we can see that Bank of America is trading for a price to earnings ratio of about 8.2. And its average price to earnings ratio since 2016, so over the past 6 years, has been about 11.8. So just like JP Morgan, Bank of America is trading at quite the discount in terms of its price to earnings ratio versus its 5-year average. But now let's take a look at the price to book. And here we can see that Bank of America is actually trading below book value right now. And the price to book is only 0.95. And what's actually interesting is over the past 6 years, Bank of America's average price to book has been 0.99. So on average, Bank of America actually sells below book value. But even today, Bank of America is selling below its historical average book value. So now let's actually take a look at Bank of America's dividend per share growth over time. And here we can see that over the past 6 years, Bank of America has grown the dividend per share at a compounded annual growth rate of 26%. That is absolutely insane. But what's also interesting about Bank of America is this bank doesn't pay as much out in dividends. And I believe that the dividend yield right now is about 2.6% compared to JP Morgan's like 3.5%. But take a look at this, because if we take a look at Bank of America's percent return to shareholders, which again is the dividend yield plus the amount of shares that the company buys back, Bank of America is actually returning. We can see here that Bank of America has actually returned about 11.7% back to their shareholders in just the past 12 months. Bank of America is returning a massive amount of money back to its shareholders. It's essentially taking the majority of the earnings that the company generates and just plowing that back into buybacks and paying out dividends to its shareholders. So this company is really focused on creating shareholder value, And if the bank can continue doing this in the future, then it looks incredibly cheap to me right now. So now let's head over to Stock Unlock's DCF calculator once again, and we're going to be taking a look at the earnings for Bank of America. And we can actually see that over the past 10 years, Bank of America has grown its earnings by 10.58% annually. Now, I'm going to say that Bank of America is going to grow its earnings at only 5% in the future, which is less than half of what it's done over the past decade. I'm also going to say that this bank is going to trade at a 10 price to earnings ratio. And when we do this, we can see that Bank of America is selling just below fair value right now. And Stock Unlock is telling us that Bank of America fair value, based on our inputs here, is about $32.29, or just about 1% above where the shares are currently trading. Stock Unlock also tells us that the projected future stock price is about $83 a share. Well, actually about $84 a share, or about 161% above where the stock is currently trading. So if Bank of America can continue to grow its earnings at only 5% annually over the next decade, then the stock does look like it is trading for about fair value right now, and the stock could yield returns of about 10% a year over the next decade. But now let's move on to the last financial and bank stock here that I want to talk about. And this one is Equitable Group. This is actually a smaller cap bank, and it is located up here in Canada. For those of you who do not know, I am Canadian. And this is a smaller cap company and a smaller cap bank, but I do think that this is a very fundamentally sound bank. And I do think that, it's just a great bank. This is actually in my own personal portfolio. And full disclosure, I have been buying more shares of Equitable Bank in my own personal portfolio, and I plan on holding these shares for the super long term. But take a look at this, because back in about November of 2021, the shares of this company were trading for about $83. And then the stock fell 36% all the way down to $53 a share, and today it is now trading for about $55.26. So this stock is in an over 30% correction right now, but I believe that the underlying fundamentals of this business have only been improving. Let's head over to our financials tab here on Stock Unlock, and let's take a look at the total revenue over the trailing 12 months. And I'm just going to zoom out all the way to 2004. Right here, you guys can all see for yourself that Equitable Bank has been able to grow its revenue incredibly consistently over the past 18 years. And the trailing 12 months revenue is currently sitting at an all-time high. This right here is an absolutely beautiful graph to me. And if we go down here and we click on the net income and the earnings and just zoom out, this is the exact same story. And Equitable Bank is sitting at an all-time high amount of net income or earnings right now as well. So the underlying fundamentals of this bank, in my opinion, have never been better. And the stock is in about a 33% correction right now. At the same time, again, as the underlying fundamentals are at an all-time high, and I believe are only going to continue improving over the long term. So now let's head over to our freeform tool here, and let's enter in Equitable Bank and get rid of Bank of America. And then let's take a look at Equitable Bank's price to earnings ratio over the past decade. And right here, we can see that the price to earnings ratio right now is only 6.1. And the average price to earnings ratio that this stock has traded at over the past 10 years is about 7.4. So this stock, in terms of earnings, is also trading at a discount to its 10-year average. So let's do the exact same thing here again with the price to book. And we can see that the price to book right now is only 0.933. So this stock is trading well below book value right now. And the 10-year average for the price to book has been about 1.09. So this stock, in terms of price to book, is also selling at a discount, and it is selling below book value right now, which I think is just a little bit insane, to be honest with you. Now, there is one thing to know about Equitable Bank, though, and that's that this company isn't really that focused right now on returning a ton of cash back to shareholders. If we take a look at the percent return to shareholders over the past year, it's only been about 1.3%. And this company pays it's actually about a 2% dividend yield right now, the forward dividend yield, but the company doesn't really buy back shares. What this company does is they retain all of the earnings, and then they invest all of the earnings into more growth for the bank because, it's a really small bank and it has been growing incredibly well. So the bank actually believes that they can invest that money and produce more returns for shareholders by keeping the money within the bank. And check this out. If we take a look at Equitable Bank's return on equity over the past decade, they have averaged a 14.7% return on equity every single year. That is a fantastic return on equity. So Essentially, this company retaining all of its earnings and then investing it back into growth, they're getting a 14.7% return on the money they keep within the business and the money they invest into future growth. And take a look at this. Let's actually compare the return on equity versus JP Morgan, and let's compare the return on equity versus Bank of America. And Equitable Group is this top line right here, this light blue line, and we can see that it has had the most consistent and highest return on equity over the past decade. If we actually scroll down right here, we can see that, again, Equitable Group's average return on equity was about 14.7%, JP Morgan's was about 11%, and Bank of America's was about 6.6%. So Equitable Bank has produced a much higher return on equity than these other major US banks. And take a look at what this has done for the company's revenue. And right here, we can see that Equitable Bank has grown its revenue over the past 10 years at a compounded annual growth rate of nearly 17%. JP Morgan has only grown revenue at 2%, and Bank of America has essentially not even grown its revenue. Now, if we take a look at the net income of these businesses and do the exact same thing, we can see here that Equitable Bank has also been able to grow its net income at 16.5%. JP Morgan is about 10%, and Bank of America is about 11.3%. So Equitable Bank has actually been able to grow its revenue and its net income at a faster rate than the major US banks over the past decade. And I actually believe that the company will be able to continue doing this into the future. So now, lastly, let's head over to Stock Unlock's DCF calculator once again, and let's enter in EQB.TO. And I want to show you guys what I'm seeing here for Equitable Bank. We're going to track the earnings once again, and I'm going to say that Equitable Bank is going to grow its earnings at 10% a year over the next decade. And over the past 10 years, remember that this company has been able to grow its earnings at 16% a year. So 10% growth to earnings going forward is actually quite a bit less than the company has been able to do over the past 10 years. I'm also going to say that this company is going to trade for a price to earnings ratio of only 7, 10 years into the future, which I actually don't think is going to happen. And I'm also going to say that the company's not going to buy back any shares, and there's just going to be no dilution. When we do this calculation right here, Stock Unlock tells us that the discounted fair value of Equitable Bank is about $64 a share, or about 15% above where the stock is currently trading. It also tells us that if these estimates right here come true, then the stock will be worth about $166 a share 10 years into the future, which is a return of about 200%. Now, check this out. Let's say that Equitable Bank becomes a larger company in the future, and this causes the price ratio to expand to about 9 as more investors are aware of this company, and just as, you know, it goes from like a small cap to more of a mid cap. More investors get attracted to it, more analysts get attracted to it, and ultimately the price ratio grows to a price to earnings ratio of 9. This would then tell us that the discounted fair value for this stock is 82%, or about 49% above where the stock is currently trading. And the stock will be trading at $213 a share 10 years into the future, which is a return of about 285%. Now, I don't know if the market is going to value Equitable Group at a 9 price to earnings ratio in the future. I would call this like my more bearish view on the stock. So even a price to earnings ratio of 7 and a 10% growth rate to earnings with no dilution tells me that this stock is selling below fair value. And again, I do own Equitable Group in my own portfolio, and this is all just my own opinion based on my own analysis on this company. This is not financial advice. I don't know if Equitable Group is actually going to return this much, or if Bank of America or JP Morgan are. But this is just kind of my thinking here using Stock Unlock's platform, and kind of just how I do some stock analysis using Stock Unlock. But that's basically going to wrap up the video, everyone. So these are 3 dividend stocks that I think personally are looking very cheap in the market right now. And I would love to hear your thoughts in the comment section below. And also, if you want a 7-day free trial to Stock Unlock, you get to use every single feature that we have for a full 7 days. You do not need a credit card or anything. Then check out the top link in the description, and you can come on here and check out Stock Unlock, analyze your own stocks, see what we have to say about them here. And it's an absolutely fantastic platform that is only getting better over time. And our number one goal here on Stock Unlock is to make you a better investor and help you make more informed investment decisions, and also focus on long-term investing, not so much speculation and not so much guessing. We really want to make you into a better investor and improve your overall returns. And that is literally what we are doing here with Stock Unlock. So make sure to check out our link in the description to get your 7-day free trial. But That's going to wrap up the video, everyone. So thank you so much. Please remember to leave a like on the video if you enjoyed it. And if you want to stick around and see more stock market related content like this, then please consider subscribing as well. But thank you guys so much for watching. I truly do appreciate it. And I really hope to see you all again in our next video.